Welcome back to Intelligent Investor Insights. I'm Josh Barone, here with Bob Barone, and today we're talking about private credit, a subject we've been writing about repeatedly over the last 8 months, including our own pieces on private debt and the coming reckoning in credit, because a lot of people treated it like some magical yield machine, and, well, machines break.
They do, especially when people pretend leverage is diversification. Private credit got popular for a very simple reason. Rates were weird for years. Traditional fixed income didn't satisfy income-hungry investors. And private lenders came along saying, we can give you more yield, floating rates, senior secured exposure, and smoother returns. That last part should have made people suspicious.
Yeah, if somebody offers high yield and low drama at the same time, you should at least check where the trap door is. The pitch was stability. The reality was often opacity.
Correct. Public markets reprice continuously. Private credit does not. That does not mean private loans are safer. It means they are not marked in real time. There's a difference. If you're using mark-to-model pricing instead of actual market clearing prices, losses can stay hidden for quite a while.
And investors got comfortable with that smoothness. Monthly statements looked calm, so people assumed the asset class was calm. Terrible assumption. A lake can look flat right before you drive a truck onto thin ice. That's probably not my best analogy, but you get it.
It's not your best, but it's serviceable. The structural risks were visible. First, covenant-lite lending. Lenders gave up protections that would normally let them intervene early when a borrower weakens. Second, leverage inside the borrower base and sometimes layered around the funds themselves. Third, liquidity illusion. Investors were offered periodic access to capital, even though the underlying loans are negotiated, bespoke, and not easily sold on command.
That mismatch matters. If I own a treasury, I know what liquidity means. If I own a private loan in a semi-liquid wrapper, liquidity means until enough people ask for it. Then the fine print starts doing push-ups.
Exactly. And the core tension here is simple. The industry sold private credit as stable because prices did not move much. But prices did not move much largely because managers had discretion, models, and time. That's not the same as resilience. It's just delayed recognition.
So that's the setup for the whole episode. Attractive income, hidden leverage, fewer guardrails, soft pricing, and investors confusing privacy with safety. Those are not the same thing. In markets, secrecy is usually not a free lunch. It's just a lunch bill that shows up late.
By 2025, the warning signs were already there for anyone willing to read past the marketing deck. Issuance was strong, spreads were tight, and that combination generally leads to bad behavior. When too much money chases too few acceptable deals, underwriting standards deteriorate. That is not a theory. It is a recurring feature of credit cycles.
Right. People say record issuance is healthy demand. Sometimes it can also mean the lender community got competitive to the point of stupidity. If you've got managers trying to put capital to work, they start shaving protections, accepting optimistic projections, and telling themselves they're being sophisticated.
Or telling themselves that private ownership and sponsor support solve everything. They do not. Analysts had flagged several weak points: looser documentation, EBITDA adjustments that made leverage ratios look better than they were, and structures that pushed obligations away from easy visibility.
That's where the meta-Hyperion financing became a useful example. Not because it proved every deal was rotten, but because it showed how leverage can be concealed off balance sheet or tucked into structures that make the headline number look cleaner than the economic reality.
Yes, investors often focus on what is explicitly reported and ignore what is economically equivalent. If debt support sits in affiliates, special vehicles, side arrangements, or contract structures that still create real claims on cash flow, then the credit risk has not vanished. It has merely been moved where a casual reader will miss it.
And that's the danger in boom periods. Everybody starts grading on a curve. Tight spreads tell you investors are accepting less compensation for risk. Record issuance tells you the door is wide open. Put those together, and the message is not all clear. It's discipline is leaving the building.
Quite right. The market in 2025 did not need a visible collapse to be vulnerable. It simply needed enough complacency, enough weak structures, and enough borrowers financed under rosy assumptions. Once those conditions exist, the trigger can be almost incidental. Credit cycles are often built during the easy period and revealed during the slightly less easy one.
Which is why I always tell clients, don't wait for flames to check whether the wiring was bad. If the loan docs are weaker, leverage is harder to see, and investors are being underpaid, the future problem is already present. It just hasn't introduced itself yet. Now, the predictable part, when people raised concerns early, plenty of industry voices brushed them off. We heard versions of, this is a mature market, losses are idiosyncratic, and my personal favorite, our direct relationships give us better control. Maybe, until they don't.
Industry defense mechanisms are always similar. First, denial, then minimization, then a claim that whatever is happening is contained. But by early 2026, the stress was harder to wave away. Redemptions increased in some vehicles. Gates and withdrawal limits became more relevant. Loan markdowns appeared with greater frequency. Once that begins, the issue is no longer theoretical.
And gating is where the sales pitch meets physics. Investors were told they had access monthly, quarterly, whatever the packaging said. Then stress shows up, and suddenly access turns into subject to board discretion, subject to fund level liquidity, subject to not making us sell the good stuff first.
That last point matters. When a fund faces redemptions, managers may sell what can be sold, not necessarily what should be sold. The better quality paper leaves first because it has bids. That can make the remaining pool weaker over time. So even if the initial stress looks manageable, the composition of the fund can deteriorate.
It's like cleaning out a fridge by eating the fresh food and leaving the mystery containers. Eventually, the survivors are not confidence inspiring. Terrible analogy number two, but again, accurate.
Unfortunately, yes. And investors should not treat these events as isolated accidents. They fit a broader credit cycle pattern: loose lending during the boom, delayed recognition during the plateau, then visible strain once financing conditions tighten, borrower cash flows disappoint, or investors demand liquidity at the same time.
So, the important shift from 2025 to 2026 wasn't that risk suddenly appeared. It's that the market lost the ability to pretend risk was invisible. That's a big distinction. Stress doesn't create weak underwriting, it exposes it.
Precisely. And when people say, well, defaults are not catastrophic yet, that misses the point. Credit weakness often shows up first in terms: extensions, amendments, markdowns, side pockets, and redemption frictions. The default statistic is a lagging confirmation, not an early warning signal. One of the more troubling developments was private credit moving more aggressively into retail channels. Semi-liquid funds, interval structures, BDCs, these gave everyday investors exposure to an asset class that was historically more institutional. The sales case was obvious: higher income, diversification, lower day-to-day volatility.
And to be fair, some investors heard private and thought exclusive, which in this business is usually a sign you're about to pay extra for the privilege of not knowing enough. The real issue is the mismatch. The wrapper offers some degree of access. The underlying loans do not magically become liquid because the brochure is glossy.
Exactly. In normal conditions, that mismatch can be managed. In stress conditions, it becomes the central risk. If many investors want out at once, the fund cannot instantly convert bespoke loans into cash at carrying value. So something has to give. Redemption limits, queues, asset sales at discounts, or stale valuations that postpone reality.
And that creates a nasty asymmetry for retail. On the way in, the asset can be marked generously or at least smoothly because there's no live market tick forcing humility. On the way out, the investor discovers the position is not actually liquid at that value, or maybe not liquid at all on the timeline they expected.
Which means the reported stability may be partly optical. I'm not saying all managers act improperly. I am saying the structure itself encourages delayed price discovery. If there is discretion in valuation and friction in liquidity, investors should assume that smoothness is not pure information. Some of it is mechanism.
And retail investors usually don't have the leverage to negotiate terms, transparency, or side letters. Institutions can ask harder questions. Retail gets the standard package and the cheerful webinar. That's not a conspiracy, it's just how the pecking order works.
A blunt but accurate summary. Investors need to understand that access is not the same as control, and yield is not the same as return. If you own something that cannot be easily sold, cannot be easily valued independently, and can be restricted in times of stress, then you own a liquidity risk product, whether the sales literature emphasizes that or not.
Here's where the unequal outcomes show up. When funds get stressed and need to raise cash, institutional buyers often get first crack at purchasing loans from those portfolios. And they may get to buy decent paper from forced sellers at prices that are, if not dirt cheap, at least favorable relative to the risk.
Yes, near par prices can still be attractive if the seller is under pressure and the buyer has patience, scale, and legal resources. Institutions can underwrite quickly, negotiate terms, and pick selectively. Retail investors cannot do that. They are captive to whatever remains inside the fund after sales occur.
That's the leftovers problem. If the manager sells the cleaner, more marketable assets to meet withdrawals, the remaining holders may be left with a pool that is less liquid, lower quality, or simply harder to value. So one group gets optionality, the other gets residue.
And the fee structure does not always help. Managers are generally paid to preserve assets under management and avoid abrupt recognition of losses. That can create an incentive to delay hard marks, negotiate extensions, or otherwise manage optics rather than provide immediate transparency. Again, this is not unique to private credit, but the opacity makes it easier.
Right. If I'm charitable, I'd say managers want to avoid fire sale damage. Fair enough. If I'm less charitable, I'd say delay can also protect fees and reputations. Those two motives can live in the same house.
Indeed, the fairness issue is straightforward. Investors do not participate equally when stress arrives. Sophisticated capital often buys assets out of troubled situations under better terms. Retail capital often experiences restricted liquidity, slower information, and less favorable positioning. That is a very different experience than the one implied during the fundraising phase.
So when people hear democratized access, they should ask one more question. Democratized access to what exactly? The upside, the fee load, the redemption queue? Because in a stressed market, equal access is not equal treatment.
Another structure investors should understand is the continuation vehicle. In plain English, it is a way to move an asset, sometimes a troubled one, sometimes just an aging one, from one fund structure into another, so it can be held longer rather than sold and fully mark at that moment.
And like most tools in finance, it can be used well or used to hide your homework. There are legitimate reasons to extend hold periods. But in credit stress, continuation deals can also keep problem loans out of plain sight and postpone a cleaner recognition of loss.
Precisely. If the valuation is internally determined or based on models with limited external transactions, the apparent loss can be softened, not erased, softened. That matters because investors looking at statements may conclude that recoveries are better or impairments are smaller than a truly competitive market would imply.
This is where people get tripped up by vocabulary. Continuation sounds orderly, vehicle sounds technical, but sometimes the practical effect is we're moving the problem down the road and hoping time, earnings, or narrative saves us.
Which is another version of masking underwriting mistakes. If a loan was made on aggressive assumptions and the borrower underperforms, the intellectually honest response is to reassess value and, if necessary, recognize the mistake. Structures that defer that recognition may buy time, but they do not necessarily create value.
And time is expensive, especially if management fees keep accruing while investors wait for clarity. I mean, maybe I'm being a little harsh, but not very.
Not very harsh, no. Investors should ask simple questions. Who sets the valuation? What external evidence supports it? Who benefits from extending the hold? And what would the asset fetch in an actual sale today, not in a committee memo built around best intentions?
That's really the theme here. Complexity doesn't automatically mean fraud, but complexity absolutely can mean delayed accountability. In credit, delayed accountability usually arrives wearing a discount. So, what matters from here? Not the glossy headline number, not the conference panel reassurance. Watch the plumbing. Defaults, obviously, but also the stuff that shows up before defaults: redemption pressure, valuation cuts, amend and extend activity, recovery assumptions, and whether underwriting discipline is getting tighter or just more creative.
Correct. I would add dispersion. Broad averages can hide a lot. Some managers may prove disciplined and resilient. Others may reveal that their historical returns depended heavily on generous marks and abundant liquidity. Investors need to separate yield from true risk-adjusted return. A high coupon does not compensate for opaque collateral, weak covenants, and trapped capital if the downside is poorly understood.
And ask the oldest banker question in the world: how do I get my money back? Not in theory, not under normal conditions, in stress. If the answer is fuzzy, legalistic, or comes with 5 footnotes and a soothing smile, maybe that's your answer.
Also, watch whether managers acknowledge mistakes promptly. Honest markdowns are not a sign of failure. Sometimes they are a sign of integrity. What should concern investors is the stubborn refusal to adjust valuations, the repeated use of structures that defer recognition, and the insistence that private means stable.
Because it doesn't. Private just means less visible, sometimes less liquid, sometimes less honest in timing. The blunt takeaway is simple: private credit is not risk-free because it is private. If anything, privacy can delay the moment when risk becomes undeniable.
That is exactly right. Investors should demand better transparency, better underwriting, and a realistic understanding of liquidity. Yield is attractive. Delusion is expensive.
There's the family motto on a pillow somewhere. All right, Dad, good one. That's it for today. We'll keep watching the credit cycle because it has a way of humbling confident people.
It does indeed. Goodbye, Josh.
See you next time, Bob. Take care.